Ever wonder why the rich seem to get richer, seemingly with an ease that feels almost magical? This isn't just a coincidence or pure luck. There's a formula to it. Dive into the captivating world of the snowball effect. It's more than just a phrase. It's the powerful secret behind exponential wealth growth. From the wonders of compound interest to the strategic game of reinvestment, this principle unveils the intricate dance of numbers that can turn a small sum into a staggering fortune. Are you ready to unravel the mystery? Join us on this enlightening journey. Before we get started, if you'd like to join a stellar investing community, sign up for a premium membership at the link in the description below. With real-time updates on a genuine money diversified portfolio, exclusive market insights, educational content, and a weekly newsletter packed with actionable strategies, it's time you elevated your investment game. Don't miss out! Join the inner circle of informed investors now. Let's get started. Number 1. Compound interest, often hailed as the eighth wonder of the world by seasoned financiers and shrewd investors, is a financial marvel that has mesmerized many with its awe-inspiring ability to generate wealth. At its core, compound interest isn't merely interest earned on the initial principal. It's a potent force where interest is accumulated not only on your starting amount, but also on the interest that has been added to it from previous periods. This iterative process ensures an exponential growth of your money, almost like a snowball getting larger as it rolls downhill. To grasp the magic of compound interest, consider this illustrative example. Imagine embarking on an investment journey by setting aside a modest sum of $1,000, expecting an annual return of 10%. As the year concludes, your money would have earned $100, elevating your total to $1,100. Now the enchantment begins in the subsequent years. If you let that amount, now $1,100, continue to work for you and grow for another year at the same rate, it isn't merely the original sum that earns interest. Instead, the interest earned in the previous year, the added $100, also starts earning, culminating in a total of $1,210 by the end of the second year. This pattern continues, with the total sum increasing progressively faster as time goes on. But the journey of growing wealth doesn't stop there. Enter the strategy of reinvestment. When your investments begin bearing fruit in the form of returns or dividends, you stand at a crossroads, to spend or to reinvest. By choosing the path of reinvestment, you essentially pour your profits back into the investment pot. This action is inextricably linked to the magic of compound interest. By not withdrawing the gains and instead letting them get reinvested, the process of exponential growth is further catalyzed, ensuring that the wealth snowball doesn't just roll, but it also gathers momentum, growing larger and faster with each passing period. Number 2. Diversification. In the journey of wealth accumulation and investment, one of the hallmarks of astute financial strategy is the principle of diversification. Picture your investments as a mosaic, where each tile represents a different asset or sector. Individually, each tile has its own distinct characteristics and vulnerabilities, but when assembled together, they form a complete and cohesive picture that's greater than the sum of its parts. As your wealth burgeons, the canvas of your investment mosaic expands, granting you the ability to incorporate a wider variety of tiles. This diversification serves as a protective shield, ensuring that downturns in one sector or asset class don't wreak havoc on your entire portfolio. By spreading your investments across different baskets, you're not putting all your eggs in one potentially fragile container. Instead, you're creating a robust structure where the strength of one component can compensate for the weakness of another. Furthermore, diversification is not just a defensive strategy, it's also an offensive one. Different assets, sectors, and markets often have varying cycles of growth. By diversifying, you position yourself to capitalize on multiple growth opportunities simultaneously. For instance, while one sector might be experiencing a slowdown, another could be in the midst of a boom. By having a stake in both, you mitigate potential losses while still enjoying the fruits of growth. In essence, diversification is like having multiple fishing lines in a vast ocean. While some might not catch anything, others could reel in a big catch. This balanced approach between risk and reward allows investors to enjoy consistent returns, tap into diverse income streams, and build a resilient financial foundation that can weather the storms of economic uncertainty. Number 3. Economies of Scale. Imagine a symphony where each instrument's volume grows louder as the orchestra expands, but instead of just an increase in sound, there's a harmonious decrease in the cost of producing that sound. This analogy resonates with the principle of economies of scale in the business domain. As companies stretch their wings and amplify their production or operations, they don't merely produce more. They unlock a unique phenomenon where the cost of producing each unit starts diminishing. This isn't about bulk production, but achieving a level of efficiency where each incremental unit costs less to produce than the one before it. Let's visualize this with a simple example. Consider a factory producing shoes. Setting up the factory might cost a significant sum, but once it's operational, producing the first pair of shoes includes not just the material and labor costs, but also a portion of the initial setup cost. Now, as production escalates, that setup cost gets distributed over a larger number of shoes, making the cost contribution from the setup to each pair of shoes progressively smaller. The result? Lower overall production costs and consequently wider profit margins. But the beauty of economies of scale isn't confined to production floors. In the intricate dance of investments, scale plays its own pivotal role. Investors with hefty capital reserves often find themselves in an enviable position, where their financial might becomes a key to exclusive opportunities. Much like a VIP pass, this substantial capital can grant them access to investment avenues with preferential fees or terms that might be prohibitive to the average investor. Such terms can range from lower management fees in funds to preferential interest rates, or even exclusive entry into high-potential investment ventures. In essence, economies of scale paint a picture of growth, not as a linear progression, but as a cascading effect. Whether you're producing goods or looking to grow your wealth, scale can be a potent ally, turning increased size into a strategic advantage, both in terms of costs and opportunities. Number 4. Increased opportunities. Imagine standing at the foot of a vast mountain, gazing upwards. The base is wide, accommodating many, but as you look towards the summit, the pathways narrow and the air becomes rarefied. This mountain can be likened to the world of investment. At its base, many standard opportunities are accessible to most. But as we ascend, moving towards more elite, high-return opportunities, the path becomes more exclusive, available only to those equipped with substantial capital. In the intricate tapestry of financial growth, having more capital isn't just about having a bigger wallet. It's akin to having a golden key that unlocks doors previously hidden or out of reach. These doors often lead to investment corridors that promise higher yields, sometimes exponentially so. Yet they come with their own set of rules, often designed to cater to those with deeper pockets. Consider, for instance, the realm of real estate. While many can afford to invest in standard properties, there are exclusive real estate ventures, maybe a prime piece of land in a burgeoning city or a luxury resort development in a sought-after locale, that demand hefty investments, putting them out of reach for the average investor. Then, there are realms like private equity, where the very nature of the game involves injecting significant sums into companies in exchange for a stake, with the hopes of exponential returns once the company thrives or goes public. Similarly, hedge funds, known for their sophisticated strategies and potential for high returns, often set a high bar for entry, with minimum investment requirements that can be in the millions. But why this exclusivity? These opportunities often promise not just higher returns, but a different kind of investment journey. They might offer a stake in something groundbreaking, or provide investors with the thrill and risks of venture capitalism. With higher capital, investors can diversify not just across sectors, but also across investment tiers, mixing standard investments with these elite opportunities, balancing their portfolios both in terms of risk and potential reward. In essence, having more capital in the world of investments is akin to having a VIP ticket in an exclusive club. It offers you a seat at tables where the stakes are high, the game is intense, and the rewards, while risky, can be exceptionally lucrative. Number 5. Leverage. Picture a seesaw on a playground. On one end, you place a small weight, and on the other, you apply a minimal amount of force, yet the seesaw tilts dramatically. This principle of using a small effort to create a substantial impact epitomizes the concept of leverage in the financial realm. At its heart, leverage is about harnessing your existing resources, whether assets or a robust financial foundation, to access an even larger pool of capital, much like using the fulcrum of a lever to lift weights many times heavier than the applied force. In the financial world, leverage often manifests as the ability to take on debt or credit based on your existing wealth or assets. Think of a homeowner using the equity in their house to secure a substantial loan, or an investor employing margin trading to purchase stocks. The underlying principle is the same: using a portion of your wealth to access funds that significantly exceed your initial investment. Now, the allure of leverage is undeniable. If wielded judiciously, it can act as a catalyst, supercharging potential returns. Consider an investor who, instead of investing $100,000 of their own money, decides to leverage their investment, contributing $50,000 and borrowing another $50,000. If the investment appreciates by 10%, the gross return isn't just $10,000, as it would be without leverage, but $20,000. After repaying the borrowed sum, the net profit, relative to the investor's initial contribution, is significantly magnified. However, with great power comes great responsibility. The double-edged sword of leverage means that while the potential for gains is amplified, so too is the risk. Using the aforementioned example, if the investment were to decline by 10%, the loss would not be limited to the investor's contribution, but would extend to the borrowed amount as well, magnifying the overall loss. Thus, leveraging, while a powerful tool in the arsenal of financial strategies, demands prudence. For those with a keen understanding of their risk appetite and the intricacies of their investments, leverage can be a game changer, elevating potential returns to new heights. But it's a dance on a tightrope, where a misstep can lead to equally magnified losses. It beckons investors to approach with both ambition and caution, understanding that with increased potential comes increased vulnerability. In the intricate tapestry of financial growth and investment, principles like compound interest, economies of scale, diversification, increased opportunities, and leverage form the pillars that guide and sustain our journey. Each element, whether it's the slow and steady accumulation through compounding or the high-stakes play of leveraging, offers its own blend of risk and reward, opportunities, and challenges. As with any journey, understanding these principles is akin to having a map and compass, guiding us through the intricate labyrinth of investment choices and strategies. But as we traverse this landscape, it's essential to remember that knowledge is our most potent asset. By comprehending the mechanics of each principle and aligning them with our financial goals and risk appetite, we can navigate the world of investment with confidence and ambition. As the horizons of financial opportunities expand before us, let's move forward with a judicious mix of caution and courage, harnessing these foundational pillars to craft a prosperous and secure financial future.